3 reasons home prices will fall by 50%. And nobody in the mainstream media is talking about these powerful economic drivers that have a huge impact on home prices. Well, nobody except for the insiders and the pros that called the last housing crash in 2008. So let's go over the reasons right now. Reason number 1, stocks are getting crushed. And I know a lot of you will say to yourself, well, George, what does the stock market have to do with the housing market? Good question. We all know about the demographic problem in the United States. The baby boomers are all retiring, but the majority of their wealth is in their home equity and their stock portfolio, maybe their bond portfolio, which is getting equally crushed. But their purchasing power is being squeezed many different ways. Let's think about inflation going up at 9-10%. And this is according to the CPI, which we know is really the CP lie. It only lies about the basket of goods. It doesn't give us accurate prices. You guys watching this video know darn well that prices have gone up a lot more than, let's say, 8% over the last year. But the baby boomers are really feeling the effects. Plus, most of the stimulus that came from the government, whether that was a break on your mortgage payment or just direct checks, are already gone or they're coming to an end. So this is going to put even more pressure on the baby boomers who are currently retiring. Well, what happens if the stock market, and this is a chart of the S&P, we're going to go all the way back to January of this year, October of today's date. What happens if the stock market goes down by 20%? And that's exactly what we have seen since January of this year. Back then, the stock market was around 47.50, and it's come crashing all the way down to yesterday. It was right around 37.90, a drop of about 1,000 points or 20%. So if you're one of these individuals that's retiring and the majority of your net worth or the majority of your retirement is in your 401k or your stock portfolio, you're looking at this and freaking out. You're saying, how am I going to retire? What do I need to do right now to make sure that I don't have to go back to work at Walmart when I'm 80 years old? Well, the only other lever to pull is your home equity. So we have a large percentage of homeowners that are forced to sell their property. Now, fortunately, most of them have a lot of home equity, but most of them are watching the news and they're seeing that home prices are flatlining, and in some areas, they're even coming down. So this puts them into a position where they're pretty much forced to sell. But let's remember that the prices or home prices, the real estate market overall is priced at the margin. What do I mean by that? Well, we've got about 84, 85 million single family homes in the United States. But at any given time, there's only around 500,000 of them for sale. So the demand for these 500,000, or the supply-demand dynamics for these 500,000, really dictate the price for all 84 million. Let me give you an example. We've got not the average Joe, but his much older relative. That's right. We've got Grandpa Joe. He is sitting here with his beard. He hasn't shaved for a while because he doesn't have to go into work. And he's got his cane because he's got a bit of a bad back there. But he's holding his 401k in absolute horror. He's shocked because his 401k has now become a 201k when you consider the massive hit and haircut that he's taken on his bond portfolio and his stock portfolio. You guys know that interest rates have skyrocketed, therefore the price of bonds has plummeted. More on that in step number 2. But he's looking at his house in this nice little neighborhood right here, and all the homes are pretty much the same. And he looks at Zillow and he says, well, shoot, my house is worth $500,000. And to make sure that I don't have to go back to work at 80 years old at Walmart or McDonald's, I better sell right now. So he puts it up on the market for $500,000, but because mortgage rates have gone so high, he doesn't get any takers. Let's say a month goes by and he starts to get very, very worried because the stock market now is down even further. So he says, I've got to sell at any price. He calls his realtor and says, drop the price $100,000. So the realtor says, okay, fine, we'll drop it to $400,000. And fortunately for Grandpa Joe, he gets a buyer immediately. But what does this do to the value of the other two homes in the neighborhood? Insert this gal right here. Appraiser April is her name, and she is looking very, very smart in her glasses and her little spreadsheet. Well, let's say that we have a potential buyer come in for this home, and the seller is asking $500,000. Well, April is going to be hired by the bank to appraise the real value of the home before they issue the loan. So she looks at the most recent comps, which would be Grandpa Joe, and says, whoa, wait a minute here. No, 500,000. Let's try 400,000. So then the bank goes back to the buyer and says, no, we're not giving you the loan for 500 because the home is only worth 400. You see, this is how home prices can come down very, very quickly, even by 50%, especially when you adjust for inflation. Now, I know a lot of you right now are kind of pushing back on this and saying, oh, George, all of this is just utter nonsense. Don't you know that the supply is very, very short? We're at all-time lows for housing stock supply, and therefore prices will just always go up. For the rest of my life, prices will continue to go up because we're in short supply. And this is a good argument, but it's an argument that I'm not only going to address, but I think I'm going to smash in reason number 3. So make sure you stay to the end of this video. The second reason home prices will fall by 50% is mortgage rates screaming higher. We see the 30-year fixed rate mortgage has gone up to 7.2%. This is a mind-boggling number when you consider a little over a year ago, they were in the 3% range. So mortgages going from a 3 handle all the way up to a 7 handle in about 12 months. This means that the affordability for homes or the demand absolutely plummets, which is exactly what we've seen. But there's some experts out there that are saying mortgage rates are going a lot higher. One of these experts would be my good buddy, Joseph Wang, who actually used to work at the Fed. He ran the New York Fed's trading desk. So he was actually the person that was in charge of doing quantitative easing and quantitative tightening. To say that Joseph knows his stuff when it comes to the plumbing of the global monetary system is a wild understatement. But he has been saying that, listen, this inflation that we have been experiencing, it is structural. It's going to be here for a while. So I'd ask each and every one of you watching this video, you've experienced significant consumer price inflation over the last year. So do you think it's transitory, or do you think that inflation is going to be with us for a long, long time? And if you think it's going to be here for a long, long time, then you would fall into the same camp as Joseph Wang. So a lot of us, including me, say that the Fed will raise interest rates until they break something. So we look at the UK, we see what happened there a couple weeks ago with their bond market blowing up and just almost bankrupting all of their pension funds. And we say, okay, well, the same thing could happen here in the United States, which would prompt the Fed to lower rates, and therefore we might see the 10-year and more specifically mortgage rates come down as a result. And that would give home buyers a little bit of a breather. But Joseph Wang says, not so fast. He believes that Jerome Powell is the next Paul Volcker. Well, I might not go that far, but he thinks that Jerome Powell is very serious about squashing inflation. So then it goes back to my original point. Well, they can only go so high before they break something. And Joseph points out that this time it's a little bit different because the Fed has all of these new tools that they could prop up the market with, or prop up the markets that are extremely important. And these markets would be the credit markets, not so much the equity markets or the real estate market. Now, to be very clear, Joseph says these are only temporary solutions, and most likely they would make things worse over the long run, to the extent where he calls these tools monetary duct tape, which I think is very appropriate. But the bottom line is the Fed has their balance sheet, and they can use the liability side, all of those bank reserves, printing up the funny money, if you will, to combat the effects of them breaking something if they continue to take interest rates higher and higher and higher to combat this structural inflation. So let's say the Treasury market blows up, like the gilt market. Well, the Fed has a tool on their balance sheet. In this case, it's a wrench. You can tell by my handy artwork here. And they have a hammer in case the bond market blows up, the corporate bond market. And they have some nails in case we have another international banking crisis. And of course, I'm just using these tools as a placeholder for these swap lines, repo facility, and debt buyback. Oh, but wait, there is more. This isn't the only thing that could take interest rates a lot higher than even I thought possible, and taking the mortgage rates along with them that would put even further downward pressure on home prices. It's also the fact that the central planners don't control mortgage rates 100%. So the front end of the curve, they control those rates to a great degree. I'd say almost 100%. But once you get out to the 10-year and 30-year Treasury, the long end of the curve, the central planners have very little control, especially if the Fed is doing quantitative tightening, meaning they're not buying any of those bonds. So to really get our head around it, I want to go over just this chart that I drew. This isn't a real chart, but it's just to show you the supply-demand dynamics here of the 10-year Treasury. And the price or the interest rate really boils down to the market participants, not really the central planners. So on the left, these blue percentages represent the 10-year Treasury, going from 4% to 7%. And on the right, these red percentages represent mortgage rates, because we know right now the 10-year is right around 4, maybe 4.5. And like we said earlier, mortgage rates are about 7%. So we can safely assume that if the 10-year Treasury goes up to 7%, let's say, we'd get mortgage rates at 10%. What do you think that would do to housing prices? But my main point here is this is really predicated upon the market participants inside and outside the United States. And this is key. To illustrate this point, we have the market participants inside the United States. These are the people that are buying, selling treasuries, specifically 10-year, 30-year, the long end of the curve. We'll call them the average Joe. And you can see the average Joe is freaking out right now because he's holding all of these bonds that have a negative interest rate when you compare them to the rate of inflation, the CPI. But then we've got the average Joe's, let's say, Asian cousin, the average Ho. And the average Ho has a big smile on his face because he's buying all the treasuries that he possibly can because the dollar is appreciating against his local currency. To illustrate this even further, editor, let's cut to a recent tweet from another market expert, my good buddy, Jeff Snyder. Jeff says in the tweet, This has happened a lot lately and not just recently. Long-term U.S. Treasuries are bought heavily in overseas trading early mornings in Asia and Europe, but then sold once the U.S. opens, meaning the average Ho is buying and the average Joe is selling. This makes a lot of sense when you look at it through the context of the dollar appreciating in value against all of these foreign currencies. So I know a lot of you right now are saying, okay, George, I get it, but why is this supply-demand dynamic with the market participants being inside and outside the United States so relevant to the interest rate on 10-year treasuries, therefore the interest rate on mortgages? And just because we have this dynamic at play, why does this mean that mortgage rates could explode higher in the future? Because we know the average Joe is a net seller. And if you believe that inflation is structural and will remain persistent, then you can assume that the average Joe will be selling into the indefinite future. They definitely won't be buying on net balance, that's for sure. So the only buyer here are the foreign investors. But you got to remember, at some point in time, they are going to run out of dollars. They don't have an infinite supply, especially if we see the dollar monetary system, the global dollar monetary system, contracting. And you say, George, well, are we seeing that? Absolutely we are. And the proof is in the pudding. Look at the swap lines that the Fed has set up with the Swiss National Bank, being used more and more and more every single week. And I could give you a list of 100 other things that show that there is a shortage of dollars in the global monetary system. And if there's a shortage of dollars, there's a shortage of purchasing power in the future to buy these 10-year treasuries. If there's a shortage of demand, that means the price goes down, the interest rate goes up. If the interest rates on the mortgages skyrocket higher, then that means the price of the homes in the United States plummet even lower. The third reason home prices will fall by 50% is low supply doesn't matter if demand is even lower. And I want to point out before we move on, it's not just me saying that home prices will go down. It's a lot of mainstream economists, like Jeremy Siegel, who's the Wharton Professor of Finance. He expects home prices to come down over the next year by 10 to 15% across the nation. And he goes on to say, I think we're going to have the second biggest housing price decline since post-World War II over the next 12 months. Mark Zandi, chief economist for Moody's Analytics, predicts that the housing market could go down by 20%. And keep in mind, these are in nominal terms, not adjusted for inflation. So when you adjust for the real price, it's down even further. And even Paul Krugman himself, during the Biden administration, obviously an administration he is very sympathetic to, even he has come out and said that long term, he sees a lot of pain in the housing market. But we have to remember, we've already seen prices come down significantly in several U.S. markets just over the last 3 months, according to Bankrate.com. Some specific data points here. San Jose down 9.4%. In nominal terms, just over the last 3 months, ending in August. Seattle down 8.2. Coeur d'Alene 7.3. San Rafael 6.2. And coming in at number 10 in the price decline is Boise, Idaho at negative 4.3%. Basically what's happening is all the people in California are getting crushed, and then the people that are fleeing California are now getting crushed as well. People that flee San Francisco for Idaho Falls or Boulder or Logan, Utah. Too bad you can't run far enough away from California to get away from those price declines. But let's not forget inflation. This is key. Remember, all these price declines are in nominal terms. So let's just assume for a moment that the real rate of inflation has been 12%. So 1% per month. Okay, well, if you've got an additional 3%, now we're down almost 13%. And you can see how this works if the nominal prices continue to decline, like some of these mainstream economists have predicted, and you layer over structural inflation of, let's say, 5, 10, maybe even 15% over the next couple years. Even a nominal price decline of 20 or 30% over the next few years, when you adjust for inflation, could easily be a price decline in real terms of 50% plus. Oh, but wait, there is more. These price declines come at a time when we have historically low unemployment. So what happens going into the next recession when unemployment spikes, especially when you consider that this is what the Fed is trying to do, increase the unemployment rate to bring inflation back down to a palatable level. And also the yield curve. We know the 2-year and the 10-year have been inverted for quite some time. But just last week, the 3-month inverted with the 10-year, meaning the yield on the 3-month Treasury was higher for a brief time than the 10-year Treasury. Let that sink in for a moment. How distorted, how fundamentally unsound is the economy when you can borrow at 10 years at a lower interest rate than 3 months? So the U.S. Treasury market is screaming that either we are in a recession now or we are headed for a very severe recession toward the end of 2022 or moving into 2023. And we've just seen the tip of the iceberg as far as nominal price declines. So assuming the bond market is right, what happens to home prices going into the next recession, if not economic depression? So the key takeaway is low enough demand caused by higher rates of unemployment, therefore a lot less purchasing power, can turn a supply shortage into a housing supply surplus. And we can see this play out in many U.S. housing markets just over the last 3 months. There are no certainties. There are only probabilities. But I think the probability is very high that U.S. home prices, adjusted for inflation, come down by 50% over the next few years and come right back down to the historic trend line where home prices bottomed out in 2012. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.